Hi, I'm Roger Montgomery from the Montgomery Fund, and welcome to this week's video insight. Well, if you haven't noticed already, yield is everything. If you're buying shares in banks, it's because of their relative stable and reliable dividend yield. Same goes for Telstra and even for BHP. But what does a high dividend yield actually mean? Well, in the current investment climate, it is a reflection, or the demand for these stocks is a reflection of very low interest rates elsewhere. That's not a permanent situation. And here's something else to note. If a company increases its payout ratio and it is able to generate high rates of return on its equity, then a rising payout ratio reduces the value of the business. This is because the part of the business that is retaining profits and compounding it at high rates of return on equity is smaller. The payout ratio has gone up, so more of the earnings are being paid out as a dividend. So while the share price is increasing as a result of the fact that the dividend yield is rising because management have increased the payout ratio, and also the fact that interest rates are very low in alternative investments, for example, term deposits and cash, the reality is that the value of the business is going down. Prices are going up, but the real value of a business is declining. Warren Buffett once said that ultimately, this is by the way in his letter, 1975 letter to Catherine Graham at the Washington Post, he said ultimately share prices are determined by intrinsic values. If the intrinsic value of a company is not rising by as much as a result of an increased payout ratio, or in fact declining, then an increasing share price will be temporary in nature. You've been warned. I look forward to seeing you again next week, and in the meantime, please follow us on Facebook and Twitter.